Welcome back. Later today, of course, Donald Trump will take the oath of office and for the second time become president of the United States. Stock market soared back on November the 6th, the day after his re-election, but since then have zigged and zagged, with investors seemingly buoyant about the prospects for a growth-oriented White House, but worried about inflation and damaging tariff wars. For his insight, let's bring in our first guest of the morning. Reid is Chief Executive Officer of Goodreid Investment Counsel and, of course, an expert in U.S. markets. Gordon, welcome, first of all.
Thank you, Paul.
Hope you had a good weekend. So markets have had a couple of months now to price in Donald Trump. The markets are hugely higher than they were after that rally on November the 6th. What's your view of valuations in the U.S. stock market right now?
Well, historically, of course, they're somewhat stretched or a little demanding, and of course, it's a relationship, isn't it? The numerator and the denominator. If it's price to earnings ratios, it's what's the price, how are we pricing the earnings, and we're discounting future expectations of earnings back to present day values, and that's what creates the valuation. So the demanding nature of the relationship is that expectations are high for earnings, and of course, if you look at sell-side research analysts, they're expecting 15% earnings growth for 2025 and 14% for 2026. So quite a bit higher than normal. This comes on the back of a good economy, comes on the back of lower unemployment, and perhaps most importantly, on the back of less regulatory pressures on corporations, lower taxes, all things that are friendly to corporations.
So those are the growth-oriented policies of the White House that the market is enthused about: lower taxes, lower regulation, among other things. Do you think that's coming, and do you think it'll be material to the U.S. economy?
I do think it's coming. How material it is depends on what else happens, and that's the great challenge of looking into the future, isn't it? Oftentimes we see things that might come to pass, but other things occur that we haven't anticipated as a group of investors, and they either offset or augment our premise. So we have to make sure that we get out of bed every morning with fresh eyes and an open mind, and make sure that we're positioned the best we possibly can be with the information available.
The market is worried about inflation as arising from some of his policies, including tariff wars, including contracting the labor force at the low end of the labor force by expelling illegal migrants. You do not, on the tariff front, you do not believe at the end of the day, after a series of difficult negotiations, you do not believe, for instance, a Canada-U.S. tariff war is in the offing.
I think there will be skirmishes. Whether it will be a war or not, I do not believe there will be. And the reasoning is that each side has too much to lose. And also there are interest groups under the rhetoric of the heads of state, being Donald Trump and the head of the Canadian government. Under that, there are interest groups that are exerting enormous pressure within their own industries, within their own geographic areas. And that's going to come to play. So we'll see a lot of rhetoric here, Paul. I would counsel our investors, anyway, our clients, to just take it easy, perhaps watch for sure, but don't act on today's news. These things tend to pass, and I would expect that will be the case here as well.
Okay, with all of that in the background, how are you positioned in U.S. equities on behalf of clients right now?
Sure. Well, we have a position in the big tech stocks, the so-called Mag 7, but it's an underweight position. We have about a 2/3 weighting to that area. These are great companies, Paul, but just the fact that they are so big a piece of the total index is a risk in itself. So we have taken that portion that we're not fully invested in that area and gone to the areas of the market that are less discovered, we think offer great opportunity. If you go below the under the hood, as they say, what you find is those big mega cap stocks are trading at a higher multiple than the Russell 2000, for example, which is a small cap index, and even the mid cap area. And we think there's a lot of opportunity there. We think you should take advantage of the types of policies that are coming along. Good example, we talked about regulation earlier. The banks lessened regulation is going to be very, very constructive for the banks, and they're in a great position.
In the banks, you like Goldman Sachs and Citigroup. Why are those your picks?
Those are two of them. We have others in the area. We've just recently purchased Goldman Sachs on behalf of our clients. They, of course, are the biggest capital markets component of the market, the player. We're already seeing a lot of deals being talked about and presented. In our U.S. small cap portfolio, for example, out of 38 stocks in the last, since Trump has been elected, we've had 2 takeovers or offers for takeovers, whereas the year before, perhaps 2 years before, we didn't see very much at all. And Goldman's going to be right in the mix there. They've reported just last week, very, very strong report. Citi, on the other hand, is more of a money center bank. It's going to do well more on the trading aspect of the market, more on the net interest income aspect of the market. We are in a period of slightly lower interest rates, but more importantly, a steepening yield curve, which is very constructive for the banks. Lastly, on Citi, it trades at a great discount to its book value. It trades at about 70% of its book value. So very inexpensive historically. We think it's a good opportunity.
And as viewers saw on that board we showed just a moment ago, you also like a couple of the big U.S. home builders, Toll Brothers and Pulte.
Yeah, we do like the home builders, and we've been involved with the home builders on and off for decades, and they've been a very, very additive part of our portfolios. The United States is underbuilt. They can't keep up with population growth. Estimates are that there are about 5 million housing units underbuilt to satisfy natural population growth and immigration. So that's a natural tailwind to the housing group. They trade at inexpensive multiples, roughly around 10 times earnings for most of the home builders. They're growing well. They're well managed. They've learned from past mistakes where in the past perhaps they would have built on a speculative basis and said, well, where are the buyers? Now they build to spec. So they get basically a template of a home. Somebody comes along who's interested in that home, and they add on to what that buyer wants with higher margins, higher margin additions to the individual homes. So they're a little smarter than they were.
Gordon, thank you.